Hey everybody, Marty Missouri, good morning, June 21st, 2018. Quick market commentary for you. I'm going to offer up, I think, some interesting slides to help you put things in perspective. Dow's down 173 points as I speak. Headlines suggest it's on trade angst. That's my position as well. Dow's down 3.3% over the last 8 days. That's a substantial drop. That brings the market, or it brings the Dow back into negative territory on the year. What's interesting, however, is that the 8-day losing streak is more or less unique to the Dow. Here's a chart of the NASDAQ Composite Index, and while it's been very volatile over the last 8 days and certainly down today, it's actually up close to 1% over that same time period. What makes that doubly interesting is that the NASDAQ is occupied largely by technology stocks. And as we've noted herein, it's really the tech sector that has huge foreign currency exposure, does the majority of its business in foreign markets. So clearly, you would think at first blush that tech might take even the hardest hit in a global trade war. And frankly, I think it still may. I do think it'll take a resoundingly hard hit if indeed we do end up in what you could legitimately term a global trade war. We're not there at this point, but we seem to be moving in that direction, at least of late. The other thing that's fascinating, and I think suggests that we aren't yet in what we would define a global trade war, is the action in gold. So gold is that commodity that people buy when they fear the end is near, or let's just say when they're really worried about markets and economies and so forth. Look at gold the last 9 days. It's actually down 2.2%. That would be unusual. I would have thought, if I had some insight into what the headlines would be over the last 8 days, that gold would actually rally. The big headwind for gold has been something that was our thesis at the beginning of the year, and we were virtually all alone there. You may recall, if you read the year-end letter, the consensus really had the dollar weaker this year, just like it was last year. Actually, the dollar has rallied quite notably, and the dollar has been stronger, and that makes sense to us based on the economic setup in the US versus the rest of the world. So we actually came into the year pretty bullish on the dollar, pretty bearish on gold. That's playing out right now. I would not have been as bearish on gold coming into the year if I knew that we actually were going to go for real on tariffs. And that's where we are. We actually have real tariffs that we've imposed. There's going to be real tariffs imposed on us. And as long as the two sides play tit for tat, this market's going to have a tough time getting out of its own way. I've maintained from the beginning, though, that it is probably the market that ultimately is going to inspire wisdom when it comes to these trade disputes. So interesting from an asset class perspective, what technology stocks and what gold are saying is that we are not going to go spiraling into a huge, messy, recession-inspiring global trade war. At least that's the position of these two asset classes, or players in those asset classes right now. So what's going on with the Dow? Well, if we look at the actual components, you can see big positions based on share price in the Dow, and that's how it's gauged. Look at Caterpillar, look at Boeing. They have just been getting absolutely trounced. Boeing's down 8.8% over the last 8 days. Caterpillar down nearly 10%. Those are big declines, and that is all about the trade dispute. Those are real, important, big global companies. So those are easy targets for foreign countries who want to retaliate and create some pain for the US. Disney, ironically, a consumer discretionary stock, is the leader, up 2.7%. That also says something, I think, about the overall disbelief that we're about to enter something that could create a big, bad recession going forward. So it may speak specifically to Disney's quest to pick up more media assets, and we'll see how that goes as well. And then lastly, just an update on the chart I updated for you the other day. We'll call this our correction chart. Here's where the S&P 500 peaked on January 26. Here's where it bottomed. Here's where it tested that bottom. Here was a very defined downtrend line. You can see perfectly the lower highs and so forth. Although this was creating higher lows, and ultimately the bulls won and broke above that downtrend. Never really tested it other than maybe the next day or two. Typically, you do test it. If they go down to test this now, it's going to actually go down below that bottom. We'll see. But the trajectory is right on line with the average duration of 10% corrections throughout history. I should say 10% plus corrections. If this one falls on the average, which surely it won't, but if it did, we would not see old highs and new highs until sometime around late August. So folks, I'll leave it there. Again, in summary, asset class action is not suggesting just yet that we have huge things to worry about if you only based your investment decisions on the charts, which is not a good idea in our view. We do respect the charts and they are in our calculus. It's really general conditions, though, that dictate how we make our decisions from a long-term investment standpoint. General conditions are still very strong, very robust. Breadth across the indicators is still good, historically speaking. So we have to view this right now, anyway, as volatility to ignore. When general conditions change and probabilities suggest that we have a recession looming, and then we'll be singing a different tune and we'll have to be accommodating for it in client portfolios, but that indeed is not where we are at this juncture. Thank you as always for watching and listening, and I'll talk to you again very soon. Take care. Bye-bye.